Thanks for taking your time out of your Friday. Really appreciate it. Welcome to this webinar. It's by the Built to Whole Venture Design Lab. It's the first in a two-part series on the topic of designing ventures for profits, not exits. The goal of this webinar is to help people understand that when you're building ventures to hold for their realized profits, that you have to approach the innovation process very differently than someone who's building ventures to exit, like a VC fund. And that's because the financial constraints that you're working under are just very different. And today we're going to unpack what those financial constraints are. My name is Erik Simanis. I wear two hats. I'm co-director of the lab, and I'll tell you just a little bit more about that in a sec. I'm also founder of a venture design firm called Half Solved. And our name comes from the well-known engineering saying that a problem well-defined is a problem half solved. And over the past 30 years, the problem that I've been trying to solve is how do you innovate new market-creating ventures profitably? And that last word is the key one. And I was drawn into this space while I was working on my MBA, and I was in a short stint with a Monsanto team that was a new ventures team. This is back in the days of life sciences. And that landed me in a doctoral program focused on this topic at Cornell. From there, I ran a lab at Cornell where we were building ventures and testing a methodology in field with a number of corporates, including DuPont, SC Johnson, P&G, organization in eye care called Sight Savers. And that turned into co-founding a venture incubation company where we guided over like a couple dozen ventures for a whole range of companies, including Barclays, BMW, Pearson, Disney, Mars, as well as a number of clean tech startups focused on emerging markets. And through all of that, we've defined the problem really well. We've really unpacked the science behind profitable venture creation, and we developed a methodology that we think just can create a real step change in success rates. And Half Solved and this lab were both created to put the science and the practice kind of out into the world. Just a quick word about the lab itself. So the lab itself, it's a partnership. It's a partnership between our firm Half Solved with the Center for Sustainable Global Enterprise at Cornell and with the International Council on Systems Engineering, or INCOSY. INCOSY is a partner because the methodology itself and the science that we draw on is all really based in the core principles, techniques, and practices of systems engineering. And the mission of the lab is as you see here, where it's about advancing and disseminating kind of both the science and the practice. And the lab has two main thrusts. There's a training component to it, which is about holding workshops, webinars like this one. We have a course that we're going to be holding at Cornell, as well as online later this year. And then we also do applied research projects. The case that I'm going to share a little bit later here, focused on Amazon, actually came out of one of the research projects. And the other one that I'm going to flag is with the MIT Alumni Angels Network. We're working with them right now to apply this science to the venture screening and venture due diligence space. So we're going to be tag teaming the presentation. There's three of us today. Joining me is going to be Patrick Donohue. Patrick is the other co-director of the lab. He's also CEO of Half Solved. And we also have Mark Eady. Mark Eady was an entrepreneur in residence in the lab until last year when he joined Ajinomoto Growth Ventures as a senior associate. I'm going to hand off to Patrick here in just a bit, and so he'll give you kind of a proper introduction. And we'll do the same with Mark a little bit later on the session. And a quick note on process.
This meeting is being recorded.
Laura, let me. I can mute you, Laura. Laura, I see you jumped on here. Pleasure to have you here. But I'm gonna see if I got you. Oh, I got you. Here we go. About the process, it's just really hard in these kind of webinar formats to do a lot of kind of live questions and Q&A. So what we thought is best is if any kind of a comment or question comes up during the session, just drop it into the chat. We'll try to keep monitoring it. And if it's something we can kind of tick off while we're going, we'll do so. Otherwise, we're going to have a little bit of time at the back end for some discussion, time permitting. Worst case scenario, we'll just do our best to really follow up at the end of this webinar. Okay, well, with that, let me hand it off to you, Patrick.
Great, thank you. You move the slide forward. So just a quick background of myself. As Erik introduced me, I'm the CEO of Have Solved and also the co-director of the Built to Hold Lab. And my career has really focused on 0 to 1 ventures innovations, both with startups, but also working with companies like Facebook, Automatic, and Rockware International, where I had a variety of leadership roles. Today, we're going to review the core challenges that teams like mine and many others have faced in running an innovation playbook that just wasn't built for our reality. And that reality is where we're building ventures that we need to hold for profits, not to sell and exit. And how the dominant innovation paradigm of today has really set us up to fail. So in today's session, as you'll see, we're going to talk about the core problem. And then next Friday's session will introduce you to how to rigorously and systematically circumvent that problem using 3 pillars of robust venture design, which you see a preview of here. Do you want to go to the next slide, please? So to establish some context here, what we're talking about is market creation. That we mean ventures that bring new core functionality into the world and which ultimately spawn entirely new markets that thrive and grow. And now that could be like a microwave, which is using electromagnetic radiation to slowly cook food from the inside. It could be creating a social trust-based solution to cost-effectively provide finance to people who were previously unbankable, i.e. microfinance. Or it could be about bioengineering pea protein with the taste, texture, and nutritional profile of meat. So what we're really focused on is the idea of ventures that bring new core functionality into the world. You go ahead. So I want to start by talking about the dominant venture building paradigm today. That's lean startup. A paradigm which really emerged from the Silicon Valley playbook in the world of venture capital. Now, whether you know the name or not, or you like using the name or not, it's highly likely that you're using lean startup as a venture building process. If you're building a venture, you're highly likely using lean startup. It's ubiquitous. And at the heart of the lean startup paradigm is this statement here. It's really about organizations that are focused on 1, searching for a repeatable and scalable business model under 2, extreme uncertainty. So it's searching under extreme uncertainty. That's what's at the heart of the lean startup paradigm. Move ahead. So looking through the lean startup paradigm, it's really, in order to search under this extreme uncertainty, lean startup centers around the concept of customer discovery. Customer discovery is the heart of what you do with lean startup. So through this process, you first go out and talk to a lot of customers to search for an idea. You choose a beachhead customer to focus on, and then build a minimal valuable product to launch it to market so you can test the idea. And then there, you take what you learned from the MVP to as rapidly as possible, iterate through a build, test, learn loop until you achieve what's called product market fit. The product market fit is this idea that you have solved the problem for customers such that it's a growing number of customers that really want and sign up for your solution. If you make it to product market fit, you continue experimenting and testing until you can do it all profitably. Find product market fit, and then from there, you figure out how to be profitable. And if you can't achieve product market fit, or you start to run out of money, you pivot and you go back to the drawing board with your customers. So this process you go through over and over again. The world is uncertain, so you talk to customers. Customers tell you something, so you build the solution. But since you can't trust what customers say exactly, you go out and test it with them, so you put the solution in front of them. All this time you're doing these activities is your way to learn. If it doesn't work out, you don't achieve your results, then you pivot. Again, this is a search method where you're moving forward. You're sort of testing the waters as you go. You move to the next slide. And really the heart, like the epitome of this, the lean startup is this analogy or this image of trying to build a plane while flying it. Which actually in the startup world is, I'm in San Francisco in Silicon Valley, it's often considered a mark of having real startup hustle. Hey, I'm building a plane while flying it. Look at me. But it's really a terrifying concept if you think about it. It's also, if you study repeat founders, it's not what they tend to do. They don't just go out and just start flying and then trying to build a plane while they're, while they're going. They think a lot about what it's going to take to get there first. So go on to the next slide. given all this, given this paradigm that's the heart of how we build ventures, there's some de facto investment frameworks that result with lean startup. The first is an extremely high failure rate. Particularly if you define success as achieving profitability, the venture is paying you back. You have less than a 2% chance of achieving profitability. It's a really long validation time to achieve that success, often way more than 10 years. And you have to suffer significant and persistent losses along the way, more than 40% of your revenue. But just a note on these statistics, while no one really tracks the success terms in terms of profitability, which in itself, if you think about it, is really a telling fact. Nobody really pays attention to this. We've been able to extrapolate this data from using data from Startup Genome and by reviewing public company performance, post-IPO data. And the result that we get from it is somewhere in terms of success rate is a dismal 1 to 5%. And it could actually be a lot worse. So this begs the question, if you want to move on to the next slide. Under what conditions does making this kind of bet pay off? You need to tolerate an extremely high failure rate, a long time frame to start generating real returns, way longer, it turns out, than most people spend at a company. And you burn through lots of cash along the way. So under what conditions does this make sense to do? We're all doing it, but what are the conditions that really make this work? There's got to be some. To answer this, I'm going to turn this back over to Erik to really dive into the financials of this and run you through a very well-known case.
Awesome. Thanks, Patrick. So as Patrick said, to help answer that question, and also to really just appreciate the nature of the problem, we did an analysis of what many kind of consider the lean startup success story, Amazon. And just a little bit of background. The idea for doing this analysis you're about to see, it came about when I was participating on a webinar with corporate innovation managers and executives. And the speaker was making the case that, look, companies if you want to create new disruptive businesses, build these new markets, you've really got to embrace that continual experimentation, the search, fail fast, pivoting method that Patrick just walked through. And the interesting thing was there was this pushback from several people in the audience. And someone raised the point that said, the whole idea of failing fast, that's just a really tough thing to get over in a corporate context. And the presenter's reply was really interesting. He said something to the effect of he said, yeah, but just think about it. You might create the very next Amazon. And it was that comment that got me thinking well, what is Amazon's actual return? How good is it? So just to recap some of the numbers, a little bit of context. We all know Amazon, founded in 1994, started with books. 9 years later, and after about $1.9 billion of losses, the company hit profitability. And today, it's a player in two massive markets. It's got 13% share of the $6 trillion global e-commerce, 38% share of all US e-commerce goes through Amazon. And the other big industry is global cloud computing, a $750 billion industry of which it holds 30% market share. Today, its market cap somewhere around 2.25 trillion, putting it somewhere again in the top 5, most valuable companies in the world. So it's a true black swan event. And it seems like an unquestionable success, or maybe it is an unquestionable success. But the question is, well, how big a success is it? It actually depends. And so let me look at it through two lenses. One, first from the venture capital view. So from the venture capital view, let's look at Kleiner Perkins. Kleiner Perkins, one of the earlier investors in Amazon, $8 million put in. 4 years, an IPO later, it turned that $8 million into a return of about 55,000%. So it left with several billions of dollars. Its IRR on that, when you back it out, is 385%. So it's a stunning number, no matter how you look at that. Now, from a corporate view, and what I mean by that, let's assume that Amazon was actually being incubated inside Walmart, and Walmart was saying, we're trying to build a new disruptive online retail company, but we're going to hold it for its cash flows. Now, if you look at Amazon through that lens, it's a little different. Oops. And question to everybody, and you could drop an answer into the chat, but like, if you look at Amazon's return through the lens of its actual cash flows, and the good thing is we've got 30 years now of actual data, plus you throw on kind of a terminal value, assuming all of future cash flows. What do you think its IRR would be? It's going to be less than what the VC was, just the way I've set this up. But what do you think? Is it A, B, C, or D? Where would you put your chips? I'll give it a sec if anybody drops it in. I'm going to do the big reveal here. Big reveal is IRR of 32%. It's more than 10x less than what you leave with from the VC view, which is quite stunning when you think about that. 32%, I mean, it's pretty good. That's true, but it ain't 385%. But let's put that IRR into a little bit more of a context. So like if you were Walmart and you were incubating this venture, you'd be evaluating it kind of on the front end based off of the hurdle rate you have. And the hurdle rate captures what's the amount of risk that that an opportunity presents me, and the return that I need to justify that investment. And I've got on here 4 different kinds of investment opportunities arrayed from kind of least risky to most risky, with ventures being kind of at the bottom. And so you see here what a typical IRR benchmark would be if you're inside of a company. So for a customer retention product, 8 to 10%. If I'm trying to come out with a new product, within that I'm going to launch kind of another version, 10 to 20%. And you see new ventures, they're down to the most risky. So kind of the average IRR expectation is 18 to 25%. So from that perspective, like I said, Amazon is good. I mean, we've exceeded even kind of like the top end of that. But I guess if you kind of look at yourself and you say like, we just innovated the 5th most valuable company in the world, at 32% is a little meh. But that's actually not even the complete story. There's more to it. So the 32% IRR that we've shared here, that's actually based off of what I call kind of the crystal ball view. That assumed that we knew going into this that we know this one's going to be a winner. We had 100% success rate going into this. But like Patrick explained, the data show like we are nowhere near 100% success rate. And once you start to factor in what's the cost of all the failures, things start to look differently. So for example, at a 10% success rate, which based off of the data is really almost like off the charts. If you had to have 9 failures, nine duds in order to get to that one black swan, your IRR drops to 21%. If you go down to a 5% success rate, now you're looking at 18%. Once you fall down to 1, you're at 14%. Now, this is where you start to look and say like, wow, like if I were to innovate and actually kind of approach trying to create my new disruptive venture kind of in this way, even birthing something like Amazon, the 5th most valuable company in the world, my return is sitting down below what I would even be expecting just at the low end of a new venture. I'm in a true kind of like a nice range, but it is very meh. Which, think about this again, like there's very few Amazons. Like if that's what you get with the Amazon, you can imagine what the IRRs look like for almost anybody else out there today. So the upshot to this, the real takeaway is that, in the lean startup, it makes sense in a VC context. And it makes sense because of these 2 key conditions. Is that one, in a VC fund context, I'm going to spread bets out over a lot of companies. We're talking 100, 200 different ventures. So I can get some of that diversification effect. I can find one of these golden goose eggs, swan eggs amidst all these other duds. But the other thing that's even bigger and more important is VC funds are going to exit and they're going to sell a venture off at a multiple of revenues relatively early on, not year 20, relatively early on, and they're doing it while the venture is still unprofitable. So what that does, it lets you suddenly move all this potential future profits up and capture it in one big giant windfall. And for me, this is the most kind of the underappreciated thing, about the VC approach, and puts into question why we benchmark off of this, is that a VC fund can generate strong returns even if none of those portfolio companies ever turns a profit. I liken it to having kind of that get out of jail free card from the Monopoly game. And so there's this real misconception, around VCs and why they're using lean startup. They're not doing it because it's the innovation strategy for coming out with new enduringly profitable companies. It is an investment strategy. It's how a fund generates profits within its 10-year life. Product market fit, that focus on show me that you got traction, show me that customer is going to buy it. This laser focus, if you want to almost call it kind of obsession with getting to product market fit, that's because it is the KPI that drives a VC fund's returns. Profitability is not going to change what they make off of a venture upon exit. If anything, solving for profitability and the time it might take to slow down revenue growth is actually going to hurt my returns on my fund. There we go. But it's for that very reason that taking lean startup into a build to hold context, into like a corporation, it's disastrous. And it's because of these, again, financially, two key things. One, you dig a very deep financial hole at the start. Two, time value of money makes it almost impossible to fill that hole that you've dug. I know probably everybody on this call kind of is familiar with time value of money, but just to kind of be clear, time value of money, really the essence of it is that money made in the future is worth less than money made today. And it's for that reason, in order to evaluate the future cash flows and the return that a company presents, we use that financial technique of discounting to reflect, what is the actual value of cash flows based off of the time and the risk that they present, which is captured using this hurdle rate. And think of a hurdle rate as, it's the minimum required IRR that a company needs on a venture. To bring this to life, I've kind of cooked up this little scenario. It's apologies, but these things are always tough to share, and no one likes to look at Excel file. But I'm going to try to kind of peel back the onion, and it's meant to be illustrative, just to give you a sense of like how these variables, these financial parameters, are really kind of coming into play. So there we go. So the scenario that I set up here is, think of this like we're looking at, we're looking at a venture opportunity that we feel like, look, we feel like in 10 years we can get to about, it's a $500 million opportunity, and then $500 million will be in the ballpark of like a 10% net profit margin. So it'll take us 10 years and about $50 million investment to get there, but we'll get there and it's a $500 million revenue play, 10% net profit margin, i.e. we're pulling in $50 million a year from year 11 onwards. And I've run these numbers using a hurdle rate of 20%. That's our discount rate. And so the first thing that I want to show you, so this is what we're coming to the CFO with, this plan, and say, look, 10 years, we need $50 million investment to get us here, but this is what the numbers look like from year 11 onwards. We got that $500 million of revenue. We got $50 million of let's call it free cash that's coming in, and that's there for in perpetuity. The first thing, I guess to point out is like, I think when you look at these numbers, I guess the immediate reaction is like, wow, this seems like it must be a really great opportunity. Like, it's just in year 11, we're already making 50 million. We're offsetting that first 50 million. This looks like the returns must be quite extraordinary from it. But let's look at what the impact of time value of money does. So if we look at what are the present value of $50 million in today's money, that 50 million discounted back, it's only 6.7 million. So when you're trying to say, I've got 50 million going out the door today, 50 million coming in the future is really only worth 6.7 million today. and you look at what happens over time, how it absolutely craters. By year 20, that 50 million coming in is just bringing in what is really worth $1.3 million in today's money. Now, if we go from this, let's look at what actually kind of is the return on capital. And we do that using kind of a metric that, again, I'm sure everyone is familiar with here, the net present value. But, quick summary, net present value simply says, we add up what's the present value of money going out against the present value of money coming in. And if we end up with a positive number, when we put all those cash flows are considered, a positive number means we're exceeding the hurdle rate. A negative number means we're not. So we see here in that final last column over there, I've highlighted in yellow, what's the net present value for all of the cash flows coming in. And it's positive, it's 51 million. And the actual effective IRR, we know we're meeting the hurdle rate of 20%, but the actual kind of IRR that this thing is generating is 25%. So again, it's like I'm sorry, I'm trying to move can you guys see my cursor? The key point I wanted to show out here is, again, like this showed the NPV. We show the NPV as it progresses kind of each year by year. It takes into consideration 50 million that went out in the beginning, and then the present value of the cash coming in. One point I want to make here is, like, look at how even by year 20, we haven't brought in enough cash to actually get us to NPV positive. NPV positive is really at the end, all rests on this big amount of cash. We call it the terminal value. So it's a way that we in shorthand capture all of the money this thing is going to make in perpetuity. We assume that this thing just keeps on living and keeps generating its 50 million in free cash flow. So we see that, if a CFO is looking at this, think how they're looking at this. They're thinking like, you're going to ask me for 50 million a day. And at the end of it, the entire profitability of us really hitting our cost of capital really rests on this thing and the forecast of us being able to still have this business running in 20, 30, 40 years. That's where the real ability for this thing to pay back all that $50 million upfront. So think about that from the perspective of the CFO. Like, is that a risky bet or what? We've created a solution that requires someone to believe that in 20, 30 years, this thing is still succeeding in turning out cash. So it's even in this, it's a pretty risky bet given kind of the structure of these cash flows. But like we said before, it's still not the end of the story. This is, again, the crystal ball view. This is a way to evaluate this opportunity, believing that this is 100% likelihood of it working. If we start to factor in those probabilities of failure, things look different. So if we use a 20% probability of success, I've done a probability weighted cash flows here. It's a shorthand way to be able to capture the cost of all those failed ventures, the other 4 failed ventures, by actually kind of changing the present value of cash flows. But you see what happens here. The moment you go to a 20% probability of success rate, factoring kind of all those other costs, even our terminal value stays negative. Even our NPV is negative. So we're not meeting even the 20% cost of capital. When you run the numbers, the effective IRR is just 13%. And in order to be able to get us back up to 20, you need to be able to go from a $500 million opportunity to an $800 million opportunity. If you're able to find 300 million more revenue opportunities, you can move this back up. If we take a 10% probability of success, we see how we get even further. Our IRR drops down to 9%. To offset that, we've got to get to 1.6 billion. And lastly, if we go down to a 5% probability of success, we're down into a single-digit IRR. And the only way we can offset that is we're no longer looking at needing a $500 million opportunity, but we need a $3 billion opportunity. All right. So again, the key takeaway here is that if you're building a venture to hold for its actual cash flows, the approach of searching for a profitable business model by experimenting in market, it's just a non-starter. We've got to have an innovation method instead that we can drive up the success rates, drive down validation time, and drive down the amount of cash it takes to validate whether or not we have profitability. And again, this is the only way that we can kind of beat this time value of money, because the time value of money is literally this massive constraint that really dictates profitability when you're in a build to hold context. And just to also add, I've been talking about this from the standpoint of corporations, but like this very same concept, this very way of thinking and innovating really is applicable to, let's call it, legacy entrepreneurs. And anybody who's building a venture and not doing this because I'm looking for an exit in 5 or 6 years and start something else, but like, no, this is my destiny, my dream. I want to build this venture and grow this thing. This is how you have to think about building ventures. It's also true for what I call like a deep impact investor. If you're investing and trying to catalyze new markets that solve big problems, whether that's climate change or that's cleaning up the oceans, like, you've got to be thinking in this way as well, because at the end of the day, your mission is only met if you end up with a enduringly profitable company on the other end. And investing in ventures when you've got a 99% plus failure rate, massively inefficient. The amount of capital that's just kind of going out and being lost is enormous. All right. Well, that's the end of just a little bit of the setup there. And let's transition. And I wanted to bring in Mark at this point, and we can also kind of field any questions that might pop up as well. But I wanted to bring Mark in because I just think Mark has this really unique background where he's had a foot and experience kind of in both sides of this equation, if you will, kind of on the build to exit, on the build to hold side. And so I just think he brings a really powerful, interesting perspective. And so, Mark, I guess the question that I'd really ask you is like, if you kind of reflect on what we just heard us present, like, what are some things that you really would emphasize that you think either that people really need to kind of understand or take away, or perhaps if there's even kind of something new that you would add to this?
Yeah, thanks, and thanks for the presentation. I mean, the Amazon case is super compelling, and I'll step back to my background first. But when I met Erik and started to get acquainted with the methodology, I had just come out of the morass of my first work with a VC fund, where I'd worked for a year and a half. And my background prior to that was in research in neurogenetics and on the commercial biotech side. And coming out of biotechnology and scientific disciplines, you're trained to build slowly, to be empirical, to be thoughtful about the way you're doing things. So moving into VC was quite an abrupt experience where I was meeting all these people who were talking about fail fast and build lean and put in as few resources as possible and go after huge market opportunities. And that was not something. And being in Boston, it's actually quite refreshing. There are different VCs who think differently about the world. And when you come in with this scientific mindset, a lot of the lean startup paradigm just logically and also emotionally feels quite corrupt. So that's when I encountered Erik. And the first piece of the puzzle for me is I got anchored to the solution, which I know you guys are going to talk about on the next call. I got anchored to the fit startup model because I had just come out of the space where everybody was building fast and failing fast, and there was no systematization of the innovation process. But I was kind of ignorant to this financial piece that you just went over. It wasn't my focus. And I was like, whatever, that's your focus. You know the finance. I'm more focused on how do we innovate better. Once I understood the thesis, the financial thesis, all this math that you've done around IRR, that's when the pieces started to come together, and I started to think about how endemic the lean startup model has become and how much it's corrupted the financial outlook in VC as an asset class. So what I was just reflecting on it is when you go through that probability adjustment, that's the real killer. And now as I've moved into this corporate environment, we talk about cost of capital, we talk about hurdle rate a lot. When we're doing investments, when we're thinking about potential M&A, partnership opportunities, all of these are being compared around their ability to exceed a hurdle rate as projects. That's how we select which projects we should prioritize, both commercially and technically. And when you build out a model for a new business, something that you might internally innovate or you might invest in, you don't do that risk adjustment for the probability. Typically, you do an IRR calculation, you model out the potential cash flows, you do a few different scenarios, but you don't factor in the probability that it might just outright fail. So that doesn't come into the IRR. And that's also the way most venture capitalists think. Because they're building a portfolio, and across a massive portfolio, they don't need to do that probability adjustment. They just shoot for the biggest possible markets so that if one of them succeeds, it doesn't matter what the probability of all those other failures are. And the other piece is this massive survivorship bias. That is the piece for me that is really insidious, is that when you talk to VCs, when they talk about the case of an Amazon, they talk about the case of an Uber, they use all of these as kind of selling tactics for why VC is an attractive asset class. But when you do the probability adjustment, they're just the survivors who made it through. They were the survivors who got to have that exit. There were probably 99 other entrepreneurs who tried to build an Uber or tried to build an Amazon and failed. So when you're in the context of a corporation, and what's great about Ajinomoto is we're already thinking that way. We're thinking about, let's do that probability adjustment. Let's account for the fact that we have to constrain our capital outlay for internal innovation. And we have to drive up the probability of success because we're not going to build 20 ventures. Most VCs don't build 20 ventures. They just invest in 20 ventures. So if we're going to build ventures and we want to have a probability adjusted positive IRR above hurdle rate, we're going to need to systematize that process and take into account the probability factor. And that means we need to build very few ventures with a very high rate of success. So that's what I would say. The probability adjustment is the killer.
Yeah.
And when people think about the innovation process, survivorship bias is the operative term. We shouldn't get enticed by the VC model because we see these big wins and bringing in the black swan. Nassim Taleb talks about this all the time, and the way he thinks about statistics is how often we ignore failure rates and base probabilities. And in the corporate environment, it's key that you don't ignore those failure rates because that can mean the difference between your business going bankrupt and your business continuing to grow and succeed.
Yeah, thank you for that, Mark. Yeah, I think this is the crux of it. It really is. And I think the issue around like the cash flows and how different you have to think about it when the cash flows are where that return comes from. I guess my experience that I end up seeing with a lot of companies and the teams who are building ventures, it's as you described. There's a funny separation between like we're building the ventures and we're coming up with these things, and then there's like the finance people who are, you guys tell us what the numbers look like, and the numbers are almost like, how would you describe it? It's almost like, well, just give us the numbers to describe what we're doing here. They're never used actually as a design kind of a tool to say like, well, is this venture good? It's almost more about just trying to like, let's build a financial model to kind of explain how this will be good. And so it's just, you have to start thinking about these numbers again as a design parameters for yourself, as opposed to they're simply something we have to do to kind of check the boxes.
Yeah. And in the private VC world, less so in the corporate VC world, but in the private VC world, that kind of modeling, once again, is endemic, which is we know, I think the silent secret of private venture capital is we know that the models we're building are super low resolution. They're built on, they haven't been probability adjusted. They're very uncertain. So this is why in private VC, everybody talks about billion-dollar markets, because the issue they're solving for is these are such uncertain models. We're going to take a little bet in this space, but the market just needs to be huge enough that if we take enough of these huge market bets, one of them pays off. So that once again there's this issue in private VC where they're not accounting for they are accounting for probability adjustment by only going after huge markets. And that was another thing for me when I looked, especially in the corporate environment. Exit out of VC for M&A is always an opportunity for exit, but corporates don't want speculative revenue. They want cash flows. They want to see positive cash flows on their M&A. So how do you build a business that it doesn't have to be a huge market? It just has to be a business that can grow towards profitability. And that was always for me a strange disconnect as well, that everybody thought you had to go after billion-dollar markets. And I was looking at businesses that were highly likely to have a great exit if people were willing to invest in them becoming profitable over the next 2, 3, 4 years and getting acquired, even if their peak market revenue was, $100 million, not $1 billion market. But
yeah,
so that was another piece that was always a disconnect.
And that too is that slide that said like how this approach is relevant beyond like a corporate who's building ventures to legacy builders. But The point you make is here, like if you're a startup and you're building a venture in a space that one, like you're not likely to get VC funding because you don't have that kind of massive growth, potential in order to meet that kind of power law returns. Like if you're in that space and you are thinking, well, I'd like to be acquired. Well, and the person and the entity that's going to acquire you is a corporate. Like a corporate is, they will need to see real clear positive cash flow, if not now, like a really high likelihood of it happening.
Mhm.
And so if you're building venture without VC really being kind of a realistic equity investor, and instead you're looking at corporate, you got to start thinking and building like this from the start, because if you don't get to that cash flow and show the ability to be profitable on the cash flow, you're not a viable corporate acquisition target.
Mm.
Patrick,
Exactly.
is there anything you would add?
Yeah, I mean, you see this at, having run and shut down innovation groups at within companies, and I'm not talking, it's not, legacy or sort of old school companies, but leading tech companies. You see this over and over again, this shutting down of innovation groups because they just can't make it work. And what you see is you see people decrying, they're saying like, well, why can't we just be more patient? We just need to be more patient. Why aren't we more patient? And you look at the numbers that you put out there, and that's why. Because when you're in a startup and you're funded by a venture, the source of your money, if you're venture capital back, they don't care if you fail. We've come across ventures where they've said, they said, we realize this isn't going to work. Can we give the money back? And the venture capitalist like, nah, just try something else crazy. Like it's expected for you to fail, like in the venture capital world, and it's expected of you following that methodology to fail. But that's not the way it is inside of a corporation. You see it inside of Disney, just even, when Disney's first bets on Disney Plus, the amount of money they put into it, it caused the CEO to lose their job. They couldn't be patient. It's like saying, why can't gravity be nicer? It's just, there's fundamental laws that you have to follow that don't exist when you're a venture-backed company, because it doesn't matter if you fail. And so, because, if you fail, if we push you to succeed as a venture capital fund, we push all these companies to succeed. We know one of them will. Probability based, yeah, success rate is really low. We try to choose something that's going to have a hyper growth market. We're going to push it to everybody in that to go really fast. We don't know who it's going to be that's going to succeed. We're going to push them all. One of you we're going to be able to get a good exit out of before you ever reach profitability. And that's how we're going to pay our investors. And so that's great, again, for the venture capital fund, but it's not great for any of the individual, entrepreneurs in it. And it's not great if you're following that model and you're accountable for the revenue and the profits that you return.
And that's another very kind of insidious point is a lot of these VCs talk about failing fast, and it's almost seen as an empathetic view. Like we encourage you to fail. And it's part of the politics of the system. But the reality is thousands of entrepreneurs are failing all the time, and they're not very happy about it. Especially when, they even if they take on $1 million, $2 million from a venture capital group, they're excited. But then they spend 3, 4, 5 years iterating and failing, iterating and failing. So the VC, what seems like empathy for failure is often just kind of a move to, because they don't have to internalize most of those failures. So if there's
Yeah.
1,000 entrepreneurs who are trying to build and fail fast, the VC can cherry pick the 2, 3, 4 that are actually growing really, really fast. So once again, survivorship bias, a lack of understanding of the probability or the base rate of probability of success. And
Yeah.
so it's not really an empathetic view.
And you see it even at, I was at Facebook during the time when we moved from move fast and break things to move fast and build unstable infrastructure. I mean, that's like the very different mentality that goes. Like in Facebook, obviously it's hugely successful, but even they started looking at it this way. And while I was there, we shut down, I don't know how many, at least 2, maybe 3 of the innovation units that we had because we just couldn't reach these, we were on the move fast, break things mentality, but we couldn't reach those types of hurdle rates that we were talking about, that we needed to talk about. And I see this again a lot of different companies that I work with and, where I coach leaders at. And this includes some of the leading companies in the world right now, the hottest startups, Anthropic, OpenAI, and others. It's like they run into this problem. They're no longer in a place where it's okay to fail. And so what does that mean? Failure here is like you've only got so much money. You got to create a sustainable source of profit growth. At some point, you got to do that. You've got something worth defending, and you can't just follow the same methodologies that you used before.
We were talking about this. There was that really interesting. It was last year. There was an article that was reviewing Airbnb, and was interviewing with the CFO. And Airbnb had these new kind of their quote big bets plays, and they're like, well, we're looking for some, again, like the new $500 million new opportunities for us. And yet you read through that and you see suddenly this complete flip from the we're going to go out there, we're going to build fast, we're going to experiment, and rather they were like, we got these things on a really short leash, in 1 or 2 years, we're evaluating them, we're keeping track, we're really looking at margin structure. And it's like, once you're in a structure where you are actually accountable for the profitability of it, it's like, you need a very different innovation process. Like I think it's liberating for people, for one. I think that's why this has become so maybe ubiquitous and universal. To your point, you're saying it's like you're like, oh, look, failing fast is a great thing to do. And it's like, we're just setting people up for failure with this kind of with this narrative of just go out there, experiment, keep going at it, you'll make it work. Getting back to something you had said, Patrick, as well about the patient capital, if you look at the impact investing sector, even kind of like a lot of foundations and kind of multilaterals that are trying to seed and create these new markets, there is this big mantra of like, we're patient capital. But this is where it's like, when you tell someone like, oh, don't worry, you've got patient capital behind you, it's like, you're actually not doing them a favor, because like them going really long and taking a long time to get to some place, you're going to be setting them up in a way that they're never going to be able to ever get commercial investment, because they're just going to keep working in a way that will never be able to generate a commercially viable return on capital. So it seems like a very kind thing to tell people, like, just experiment, work on this. Like, you're not actually helping somebody. It's better to tell someone like just getting clarity around financially, what are the parameters you need to be solving for when you're starting this. You're putting someone on a foundation for future success. The other one is a bit of this really slow kind of gradual pathway to decline. Next session, we'll get into some of these questions that really kind of open up the door on a very different paradigm and way of dealing with uncertainty. Because uncertainty is there. It's this fundamental thing driving kind of the search process. But we're going to present to you a way that we're actually not trying to like search through uncertainty, but how do you engineer robust ventures that can withstand uncertainty? And we'll talk about these 3 key pillars that you see right here. And I think this will move us from being kind of like poking holes at something, but really kind of showing you a way that we're seeing to solve the problem and give you a chance to now poke holes into what we're doing.
Thank you so much, everybody.
Thank you, everyone.
And so hopefully see you again next week. If you have any questions, I think you've got Erik. You can reach out to Erik at halfsolved.com. And we will talk to you soon.